options, things like that. Specific to SBA, what my team does, we help a wide variety of people from acquiring equipment, acquiring real estate. That's kind of another big step in some of the kind of franchise spaces, going from leasing to purchasing, and then kind of getting the capital to do so. One of the benefits of SBA, we're going to have some of the longest terms and some of the lowest down payment. Preserve your capital so you can keep running your business versus putting all the money that you have that you've saved into buying whatever it is that you're trying to buy. And so like I said, SBA is one option. I'll leave some of the other options to the other gentlemen.
Well, some of the franchise concepts will have strategic partnerships with conventional lenders. But those are usually, concepts that have been around for a while, have a proven track record. So a lot of, especially on the, as Jimmy mentioned, smaller chains, newer concepts, your lenders are really pushing towards the SBA. So there's, I guess we'll talk later on about equity, but Jimmy mentioned real estate. That's one way that you can kind of control your fate, can help out as far as minimizing your tax liability. And but when it comes to franchise space, I think the SBA has helped out tremendously because we're willing to do what they call leasehold improvements. And so we're able to do a unsecured or undersecured loan that a traditional bank will not do. They want equipment, they want hard collateral. And so that's one of the key benefits that the SBA has provided to the franchise space.
Awesome. All right. What are the criteria that the SBA or non-SBA lenders are looking for? And maybe I can start with you, Mr. Mayor.
Yeah, I think one thing to start out is, if it's a startup, is a business plan of kind of understanding your SWOT analysis, strengths, weaknesses, opportunities, and threats. Also, kind of understanding your capital stack, like how much capital equity is going to be required, how much you're going to acquire for some senior debt with a conventional lender. Also, look at your liquidity position, working capital needs, how much time is going to be required to really get established, have a stable cash flow to start repaying those obligations back. So it's a myriad of things, but I think the most important thing is starting with your business model, thinking through your strategic strategy, and something that you can present not only to a lender, but also to a potential equity investor.
Anthony, you want to expound upon that?
Yeah, I think equity is a little bit different, at least from my perspective. We want to understand who the owner is. We want to understand the operations. We want to get down in the weeds a little bit more on the operational side. Whereas a lender, they want to look at the financials. We want to build a relationship and understand the mentality of the potential franchisor. So ours is not only just financial based, but it's also character based. So we want to understand, is this model repeatable? Do you have standard operating procedures? How is your growth plan? If you're going to look to raise capital, what's that operational plan look like as well? Are you at a point, and this is in any business, and banks look at it the same way too from some perspective, is the staff and is the resources that you have today going to be capable to get you to where your projections say? Now that may be a different story when you start thinking about it, because we're a little bit more intrusive. Banks will be straightforward. We're going to hit you with a workbook, so to speak, and say, we want to look at, what do you want to do with real estate? Do you have any real estate? Do you have an employee plan? Don't bring your credit score. One of the biggest things is we don't look at the credit report. We want to understand the structure. Do you have a good accountant? Do you have a CPA? What does your legal structure look like? Can you take on capital? Have you taken money on from friends and family? We want to look at the debt schedule. We also want to look at what we call a cap table, like who has ownership. So I think it's really, ours is a little bit more, not to say the lenders aren't relationship driven, but we're gonna be like your first or second cousin. That's the type of relationship we're gonna have.